Hey everybody, it's Larry Berman here. Crazy week, cockroaches, wars ending or not ending, um, you know, trade volatility. One day it's good, next hour it's not. You know, President Taco is at it again. Every time we see a little bit of softness in the S&P 500, he seems to end up on social media or regular TV talking about how wonderful China is. So, that's the what we learned this week. When we look at different risk markets, there's definitely a message that's building. Let's have a dive into the chart room. You're rarely going to see me lead with something on Bitcoin. It's gaining more interest. There's more retail money involved in individual investors with the advent of ETFs in the US. And I suspect the election of President Trump that's really pumped the sector. So looking at the chart here, we definitely see a failed breakout and reversal. When something bullish happens and it fails, it's bearish, it's usually really bad news. Market for Bitcoin cash is trading through the 200-day average. We've got this sort of modified rising trend line, which isn't perfectly drawn, but comes up, under the support that we saw a couple months ago, just below 100,000. But really, I'm expecting right now a correction somewhere between 70 and 80,000 approximately, using rounding, where we could see a risk-off event take us. What causes that? Any number of things. Meeting with Xi doesn't go well. 100% tariffs for a little while and all that. So while it is very true that 100% tariffs on China is unsustainable and it will be walked back and negotiated, it doesn't mean the rhetoric won't keep playing out that way in the coming weeks. Is that a reason to sell your Bitcoin? Not if you're a long-term believer, but you are trading a speculative volatile asset, and you have to understand that part of it. When we look at the cockroach in the room, Jamie Dimon said in the earnings report this week, they're seeing a cockroach, and usually when there's one, there's many. And that really caused a big reverberation in the private credit space, everybody speaking out against. And so we're seeing a little bit of a bounce late in the week, but you had a couple of regional banks, Zions, Western Alliance, come out and talk about loan losses, in particular, some bad loans in the credit side. We're at the end of the market cycle here, business cycle. You're going to get this stuff. It's normal. But when the markets are priced for perfection, it takes a while for this stuff to get out there because nobody really wants to believe. But again, when we look at some of the risk areas, we're just seeing these things. BISD is an ETF that represents the BDC basket of public companies, and same story here. I think the test of this level was pretty good. The tariff lows, and it's bounced. We've got to make a bottom here. It's unlikely to be a V recovery. Now we are seeing stuff in the bond market that suggests rates are going lower. We heard from Waller this week talking about what he would do if he was in the lead. He talked about restructuring and it's okay to dissent in your view, cited the Bank of England on how they do it. I think it's perfectly okay to dissent as well. There shouldn't be groupthink at the Fed. There tends to be groupthink at the Fed. When we see where the money's flowing into the risk-off gold and gold miners, we're seeing a bit of take some money off the table trade there at a minimum. But this trend is pretty strong. We could easily see a pullback in GDX towards some intermediate term moving averages and still be in a pretty robust uptrend. I would look for some money to come out of the gold sector in particular. If we look at crude oil, so Putin and Trump are going to meet. If that ends, more normalized oil supply, perhaps. India's not going to buy from Russia anymore until the war is over. So a lot of moving parts there. Crude oil prices come off a bit this week. Some pressure there. I get asked what your favorite pick is all the time, every week, every day. Someone stops me on the street. I've been talking about medical marijuana, MSOS. Talked about that a few weeks ago. Oil and gas drillers, when oil prices are weak. Now, these stocks have come off quite a bit from their recent highs, 10-15%. You can see there in the XOP ETF. These are relative range oversold. This is not wholesale liquidation. So, what's cheap? I'm nibbling on some oil and gas names on this little bit of a pullback and weakness in the sector. If you like it long term, like I do. But weaker oil prices, some risk off stuff coming off. It's telling me that the selling is broadening out here. Still, nobody really wants to sell the Mag 7 and the tech names in the S&P. Where is some of that money going again? The long end of the curve. We love TLT down here. We talked about it a lot on the weeklies here, that if you want to hedge your equity risk, the long bond exposure, it's still a trade here, but it's not as attractive as it was when TLT was at 85 and long bond yields were over 5%. I think we're capped somewhere between 95 and 100. I don't know. I've picked 97 as this gap in here, where I've sold my calls in the sector and done some of my hedging for my fixed income allocations. So I don't think we're going to see a huge breakout, but what would break out the long end in a big way is really weakness in the labor market beyond what the Fed can address right away. That's going to hit stocks broader in earnings. So this is still a pretty good hedge for now. Quarterly refunding announcement early November. If we hear good news on bond supply, that will be seen as a positive. If we see bad news on bond supply, that's going to help cap the upside here in terms of where TLT can go, because the long end needs to digest all this. But if money's coming out of equities and still wants some duration, then a long end of the treasury curve is going to come. If the front end of the curve is pricing about as low as the Fed's going to go towards 3%, and if you look at where SOFR's priced to the end of next year, there's not much room left there in the front end of the curve. So money's going to migrate out the curve into duration here. Definitely a dip buyer in terms of duration and TLT. Again, 95, 97 is probably where this rally would get capped in absence of a complete economic shock to the downside. I mean, knee-deep recession, in which case this can rip a whole lot more. We could see the long bond get to 3.5% or so, and we could see this up at 105, 108, where we were at the depths of the markets in 2002, as you can see there in the chart coming out of 2002, where the long bond was. Anyways, that's all we have this week. Have a great one, everyone.